Bear rally or new bull? That's really the only question that matters. And to help us answer it, we brought in national treasure, technical whiz, and a friend of mine, Louise Yamada. Louise, what's happening out there technically? Can you help fill in the picture? And is this a rally? Should I buy them up here now?
No, we don't think you should buy them up here. I think that the markets have been deteriorating for several months, particularly the emerging markets, which I think we discussed the last time. And the carryover, or what you could call the catalyst, was the downgrade of the U.S. debt. I think it was just a catalyst that created the downswing for an already weak market environment. We have very, very deep oversold readings, characteristic of some of them from 2010, but more significantly from the 2008 period and the 2000 period, which suggests to us there is the possibility here that we're entering. We've finished the bull market, the cyclical bull, and we're in a new cyclical bear. Most of the global markets are down 20% or more. The U.S. and the New York Stock Exchange, the Russell 2000 are already at the bear market 20% threshold. And having in place our 3 momentum sell signals on a monthly basis for most of the markets except the U.S. at this point suggests that we're looking at a bear market environment.
Louise, when you use the term we're in a new cyclical bear, translate that for people who don't know. What does that mean mathematically, numerically?
20%. The definition of a bear market is a decline of 20% or more. Cyclical meaning it may be a cyclical bear within a structural bear, or it could be a cyclical bear decline within a structural bull. We happen to think still it's within a structural bear market that started in 2000 and may not be over for a while, but you get cyclical advances like the one we just ended from 2009. We had a terrific cyclical advance from 2003 to 2007. But I think now we've entered a new cyclical bear phase.
Much is being made of the death cross when the shorter-term moving averages cross over the longer term as sign of a rollover and perhaps a suggestion of a continuation. Is that something you pay attention to? And if not, what are our best tells in terms of rolling over?
No, definitely one should pay attention to that. They can turn around quickly. I tend to look at that, but we prefer to see our 3 momentum gauges move into a sell mode on a monthly basis, which has happened here in most of the global markets.
What are those momentum gauges?
It's the MACD, stochastic, and the ADX.
Let me just ask you a question about volume, because that's everybody's favorite indicator, right? The money, you can't hide volume.
Right.
And the volume on the rally days is less than the sell days, and that does not bode well for...
It does not bode well. And not only that, but from January to present, you have had a decline in volumes as the rally progressed. That was one of the telltale underlying signs. Now everybody watches the cumulative advanced decline line, which in this case did not give a negative divergence. But we had been cautious on that because it didn't give one in 1937, it didn't give one in 1977. We know there are occasions in bear market environments where the AD may not speak, but it's the weight of the evidence. Your new highs versus new lows were deteriorating, volume deteriorating. So we had been growingly more cautious.
One of the indicators I like to look at, and it's a technical term, is the crossover into Crazy Town or Looneyville, which we saw last week with the extreme volatility up and down. What does that tell us? Is this our rallies to be sold in the context of this bear market? As we get up, down 5%, is that something to be taking advantage of, or just merely more evidence of a volatile market to be avoided?
Okay, I think probably the latter, volatile market to be avoided, but I think that an enormous amount of damage has been done here to individual stocks. So the stocks that have really had severe support breaks could use those rallies to lighten positions if you didn't have an opportunity. And in some cases, the uptrends were just sliced right through and you got your 20% down. That was characteristic also of the German market. The DAX had been the strongest one in Europe, and yet when the decline came, it just broke the trend line and went down over 20%.
What will give you confidence to get back in? What do you need to see?
Well, generally it takes several months. Even in 2010, it took about 4 months for us to see the proof of the pudding, for the alleviation of the oversold readings. Of the oversold is the empirical evidence of selling pressure. And when you're in an advancing market, those oversolds can be very quick and brief, and traders love to go in and buy them because they can give you a profit on the outside. Right. But when you have the more structural evidence that you've got a weakening overall environment taking place, and those oversolds come into play as deep as we have seen today, similar to prior bear market environments, you really want to just stay on the sidelines until that alleviation is over, and it takes 4, sometimes longer, months. We would much rather wait for the confirmation that the decline has ended, that the risk is over, because the deep oversold, as long as they're in place, can allow for, let's say, further downside risk. You know, there are only 2 losses that you take, a loss of capital or a loss of opportunity. And we'd rather be out of the market wishing we were in than in the market wishing we were out.
There'll be another crosstown bus.
There'll be another opportunity.
The bottoming process.
Well said.
Yes.
Is it any wonder I love her so and consider her a national treasure? Because no one delivers negative news more sweetly and concisely and insightfully than Louise Yamada. Louise, thank you so much for joining us. There's no such thing as too sweet with you. She's with Louise Yamada Technical Research Advisors.
Anybody who's ever watched a crime show knows when there's a murder, you got to go back forensically and look for the evidence. We're bringing Louise Yamada Technical Advisors, to give us, well, some insight on kind of what was the evidence that sort of suggested maybe this was going to happen. It was a short, volatile event, but you saw it coming.
We have, yes. We've been growingly cautious, and distribution patterns take a period of months. Our last report was a little bit more cautious. But yes, the foreign markets, the emerging markets, when we last spoke, were underperforming the developed. The U.S. was outperforming everybody, and actually still is, in the sense that we don't have those momentum sell signals yet in place. But India and Brazil had given these long-term sell signals a long time ago, and we started to see it come into some of the other markets, and now just about all of them are on momentum sell signals, with the exception of Japan, Thailand, Jakarta, and the few U.S. markets.
Japan. Now, Japan's been left for dead since 1989. You like it here, or there's just no room left to collapse?
I wouldn't like it to see it break support here, because there isn't anything underneath. The other markets, at least most of them, have held at the 2010 range of support. There are a couple that have fallen through it. Australia, France, and Brazil are already through the 2010 support level, so there is a little precedent there that maybe the next decline could bring that support into question. But Japan is really on its last legs. If it breaks the support, that's in place right now, then you're looking at something that could be defined as a 25-year top, and I don't want to go there.
It looks like Europe is still under pressure. Germany just coming out with a clunker of a GDP number. I mean, that has macro ramifications and indications for the full world. Again, how do you look at Germany as the leader in Europe, and how do you play the whole European market right now?
I'm not sure you play. I mean, there are days when you just don't play. Stay on the sidelines. Germany was the strongest market, and it had a very severe setback. Let's see how far down Germany went. It's down 24%. Already, and it went right to the bottom of the 2010 support. So any further decline there, you're bringing into question whether or not the markets go back to the 2009 lows.
We just sliced through uptrends, and that's why uptrends exist, is once they break, no one here gets out alive, and they just plummet. Is that going to create a lot of supply out there? I call it the prayer of the bad trade. Please, God, just get me back to even, and I'll never do this again. Is that the kind of supply we're going to see coming in, and is that exacerbated by the speed with which we went down?
I don't know how much it's exacerbated, but certainly that creates a bit of unsettlement in the investor's mind. I would think that that rallies would be best used to lighten some positions.
If you take a look at Asia, the whole China story is coming into question. I mean, they're growing, but we're not sure exactly how fast. Hong Kong's getting hit harder. It's a more liquid market. What do you think about Asia in terms of on the way out? I mean, it's like the lone growth story out there.
Yeah, well, the Hang Seng has now slipped back to the bottom of the 2010 support, which is very intriguing. So it's been in a range between 2,000 and 25,000, and now it's fallen below the midline, and it's right back at the long-term support there of the 2 years. So I would say we're at a critical juncture. on any further decline, whether or not those support levels hold.
Now that our trend lines are busted and we're getting back to 2010, for perspective's sake, the U.S. market is really just back down to where we were, give or take, during the sell-off last year. We haven't seen this kind of volatility in 12 whole months, and everyone's shrieking. If those support lines break, what is that telling us? And since they've broken internationally, does that bode as ill for the U.S. markets as it would seem?
I would think so. I would think so. I mean, New York Stock Exchange is already down 20%. It's right in the support range. So is the Russell 2000. All of the other U.S. markets, although they aren't down 20% yet, they're close, and they're right into that 2010 support. If we break that, the next levels is the bottoming process that took place in 2009.
It's amazing to me, all these trend investments, the BRICS, which were so hot and outperforming for so long, have gone ice cold. Brazil, for example, their real was appreciating very, very strongly, which, they're trying to deal with. But as a market, a lot of pressure there.
A lot of pressure. Maybe it's because of the strength of the real. Now, Swiss market was one of the first in Europe to collapse, and yet people are buying the Swiss franc. So it's having
hand over fist.
It's having an offset on the ability of the market to move up, because it makes their goods more expensive.
All right, Louise, great. Thanks, as always. Appreciate you coming on. Louise Yamada, the one and only, here on Breakout.